Today I would like to discuss money, what it is and what it is used for. Money originated as a solution to solving direct barter exchange. What historically people were doing in society was exchanging via barter or direct exchange, which is the idea that if you have something that I want, like a cow, and I have something that you may want, like eggs, we can exchange our eggs for your cow. And this will obviously had many problems considering the fact that maybe it's not eggs that you want, but you want a goat. And then the problem of divisibility. Well, how many goats are worth one cow? So then prices became ratios, but then the price was in cows or goats. So barter was very difficult to create complex economies and therefore wealthy societies. So money originated as a way of indirect exchange. That was, okay, I'll trade you this type of good, not necessarily a consumer or a producer good, but a good that will be used for a later date that we can easily divide. It has a divisibility aspect to it. It's lightweight. We're not transporting cows. We're cutting maybe wheat or shells or stones down to a divisible unit. And so money became something that was relatively easy to transport. It was divisible, and it had essentially a perceived value that could be used for a later date. Because eggs have a shelf lifespan, they couldn't last long per se. But something like wheat originated as one of the first forms of money because it relatively lasted longer, easily divisible, and it was easy to transport. And so these are some of the features or characteristics of what money is. And money essentially was allowing people to help their desires to accumulate other goods that they wanted through other exchanges at a future date. It was over the centuries that the metallic standard arose, which was using gold and silver as the main forms of money. Primarily gold, because it was valuable in the sense that it was a commodity and people would use it for jewelry as well as some industrial uses. So there was a value associated with it. Then, over time, governments tried to use forms of coin clipping or establishing a certain value for gold in a ratio to silver that not necessarily the market or people would agree with. So there was means of devaluing the coinage, and this allowed the people who were the states at the time who accumulated these coin clippings to then melt them down and reissue more money into the economy, but from their own pocket. So then they would be the ones who would have the relative advantage in consuming products for their own desired ends. And the history of money really goes inside with the history of banking, with banks being money warehouses that would store money. And then you had the Bank of Amsterdam, and then some banks that began to partake in the practice of fractional reserve banking, which was the idea of saving only a percentage of what was deposited in the bank and loaning out the other percentage, typically 90%, while saving 10%. And then using fiduciary media, which was the money that was lent out from the initial deposits inside the banks. And so this fiduciary media was not necessarily the bank's money, but someone else's money that was then attributed as new money in the market. And so then you have a creation of new money in society. 1913, in the United States, you had the creation of the Federal Reserve, which was a central bank institution. And I believe Edward Griffin has a good book called The Creature from Jekyll Island. 1933, the US government went off the gold standard because the dollar represented a specific weight of gold. And then in 1971, the US government officially went off the gold standard. So it became what's known as a fiat currency, or a fiat money. Fiat meaning by force, which is by declaration. That money is not backed by a good or a commodity or a weight of gold, but by the trust and the value that people put behind it and what the government says its value is. So then you have to combine a fiat currency with things like legal tender laws. Legal tender laws essentially saying that this currency that we instill in society is what is considered to be money, and not allowing markets for money. But money is a good like anything else in society. it is a type of good that facilitates the medium of exchanges, combined with the idea that all exchanges clear on the market because it comes from reverse preferences that say I trade with someone from another country a good and they take my money. It's because I wanted the good and they wanted the money. And then in the long run, when I produce a good, someone else from another country wants to buy this good with their money, then I get their money. And so then you have the economy that is always clearing. So there is no aggregate trade deficits because none of the trades occurred as a deficit. It was a clear market exchange that allowed for all parties to be better off. Thus, economics and the welfare of the trading parties grow. And this is the ideas of mercantilism, of having positive trade deficits, that, oh no, our money is leaving the country. That's an issue. But at the same time, if the money is leaving the country, it means you're buying other goods and services. So then you have an import of goods and services. And in the abundance of goods and services, that is what wealth is. That is what money is used for, to buy things. Money can psychologically be held as a fetish, but that's not typically what money is used for. It's not money in itself that's valuable. It's what people can buy with the money that they have that is valuable. So with the creation of fiat currencies and paper money, then nothing became easier to produce for central banks. So the central banks began technically loaning to the government ad infinitum, and the governments would incur this debt, but the money used to pay for the debt is also used by the money created by the central banks. So you have this essentially debt form economy that's not backed by creating goods or services, but by purely printing money. And that is the artificial prosperity of an economy, is using fiat currencies to pay for goods and services that essentially creates a bubble, an illusionary prosperity that has to be eventually reaped by future generations. And when we think of prices, it's important not to think of prices as like this price level. Prices, as Joe Salerno described, is like a swarm of bees, where each bee is like an individual price. And as the bees move, that's kind of how prices are adjusting to their relative surrounding or environment in a society. And so then a price becomes purely from consumer preference of how much one person is willing to pay for something. The prices of producer goods are determined by eventually what consumer product they can produce. And so then the price from the consumer paid for the consumer product then determines the price of the producer goods that contribute to the production of the consumer good. Under the modern fiat economy that Americans are currently experiencing, they view this concept of inflation as an increase in the price level. But it's a distinct misunderstanding that inflation can be more accurately defined as an increase in the money supply, where when you increase the money supply, it's just an idea of supply and demand that each individual monetary unit decreases in value. Now, prices adjust over time. So when the bank creates money and injects it into the economy, it doesn't spread out equally like a rising tide. It's more like, as Hayek describes, a pool of honey, where it's injected first to the banks and the friends of the banks, and they make these loans, and in their investment projects, this money then disperses out to the economy, and it is the relatively less fortunate people in the society who obtain the new money created later in time. But because the first people to receive the money have bought resources and products at specific prices, this essentially increased demand for these goods and services then is an upward pressure on prices. So then, due to supply and demand, prices will rise. And eventually, when the later receivers of the new money that's created receive the money, the prices have already adjusted and they've risen. So this is the inflation that people experience. It begins with the creation of new money. That's the original intervention in society and the economy that then creates the distortions or disruptions of people's savings, workings, and earnings. That is why the system of central banking is pernicious, because some people need to produce goods and services for their income, whereas other people, like central bankers and governments, can print it with the snap of their fingers out of thin air. So they don't need to work for the money. It's useful to have professional economists who can say that this is very technical and mathematical, and you shouldn't worry about it because we're professionals. So we will determine how to increase the GDP and sustainability of an economy. And actually, at the end of the day, the solution is always print more money because it favors the government and it favors the professional elites, if you will. So there is no free market in money in the current society. If we have a free market for money in society, then that would actually be very curtailing on the ability of a government to increase more money, because then people will be able to understand where their money is directly being taken from, rather as opposed to today, where just by the stroke of a pen and decision, arbitrarily, governments are allowed to print money. And this is what harms people the most in their savings, their energy, their time spent having to spend more time on labor rather than leisure, pursuing, time with friends, family, in the creative endeavors. Now more time must be spent laboring, which is why it is so pernicious. And it also distorts the economy going into the lines of production that, due to the artificially lowered interest rates, investment projects of higher time preference will be initiated and more likely to be pursued, because this is what's going to make deals with the banks. So it is observable in the real world how artificially lowered interest rates and the creation of new money manifests. We don't have things like the Sistine Chapel and beautiful architecture in the United States. Why? Because the money is cheap and easy and incentivizes higher time preferences, which means shorter time investment projects of production. That is why art and architecture has manifested in the way that it does in designer chic or modern brutalism, if you will. When we have the technology and the capability to produce beautiful works of art that may take centuries to come to fruition, we don't engage in it because the money has been distorted, and it's distorted people's incentives or their desires of what types of ends to pursue in society and in life. And frankly, in the ideas of freedom, freedom only comes with individual sovereignty. And individual sovereignty can only be manifest with monetary sovereignty. So when you have a monetary revolution that allows for monetary sovereignty for people, then you will experience more freedom in society. Thank you.